Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is our latest offering, What's Hot, and a show that truly focuses on what's the biggest buzz on the D Street. Well, what's hot in the world of investments right now and what everybody is talking about truly is specialized investment funds or SIFs. This is the newest innovation in India's capital markets. What are SIFs? That's what we are going to be decoding for you on this program. Remember, this aim of launching SIFs is to actually bridge the gap between traditional mutual funds and alternative strategies by giving investors an access to both long as well as short opportunities in a regulated structure. So let's start to decode what are SIFs, how do they work, and should you invest in SIFs or not? To decode this for us, we have two special guests joining in on the program. Niranjan Awasthi, Senior Vice President, Edelweiss Mutual Funds, is joining in on the program. And we also have with us Aditya Agarwal, the co-founder of Wealthy.in. Warm welcome to both of you and thank you so much for taking the time out. Good to have you both to talk about this latest innovation on the D Street and what everybody has got their attention around as well. Niranjan, I'm going to be starting this conversation with you to help all our viewers just broadly understand how are SIFs truly different from traditional mutual funds. How does one really understand this as an investment product?
Hi, very good morning, Sakshi, and thanks for having me. Traditionally today we all invest and we know mutual funds exist for almost 30 years. Very good track record, very well regulated structure. SEBI time and again has made mutual fund the most transparent product structure that we have in India. However, if you see, mutual funds have a lot of restrictions because there are small retail investors also investing in them, and the structure is very simple. They invest in debt instruments, equity instruments in the cash market. Various categories are there. On the other hand, you have AIFs and PMS, especially AIFs, Cat 3 AIFs that are allowed to invest in derivatives, do long short. So a bit of complexity. Now, somewhere in between of these two, mutual funds and SIF, is mutual funds and AIF is SIF, where it has all the regulatory transparency, well-regulated structure like mutual fund, but it also has additional flexibility to do trades into derivatives like AIF. So it's basically a best of two worlds of mutual fund as well as AIF, and it's basically for clients who have a larger ticket size compared to a retail investor who invests in mutual funds. They are willing to invest minimum 10 lakhs in such asset class, and with the use of equity, debt and derivatives specifically, they have very differentiated payoffs and risk and return profile compared to normal mutual funds that exist.
Absolutely. So one thing is the ticket size, the entry, and that's the 10 lakh rupee mark, and that's what is going to be a clear differentiator, because a lot of mutual funds, they allow you to start your investments at a very lower ticket average price, but in SIFs you need to have like a large ticket size, and in case you are willing to explore that, then you can actually see how the best of both worlds actually combine to give you this product of SIF. Aditya, I'll come to you also for this understanding of SIFs better. Somebody was just mentioning to me how traditional mutual fund investors benefit only when the markets rise, and SIFs therefore actually give you an opportunity on both sides wherever the markets rise and fall. Is that the right way of understanding SIFs?
Maybe, but I think what has happened in the last 5 years is that because of the amazing bull run the concept of asset allocation has kind of lost its place, right? Because ultimately, when an investor is investing, they have to look at when do they need that money back, because ultimately we're investing to create that wealth, and ultimately we'll need that money back for it could be your child's education or whatever it is. So often what has happened is that we have lost out that concept of asset allocation because equities have done so well. So I think when I speak to clients, I think SIFs can actually bring that concept of asset allocation back on table, which because of debt funds sort of being out of favor had lost out. Because what happens is, let's say if I want to have an investment horizon of just 2 years, an equity mutual fund probably cannot meet my requirement of that. Whereas an SIF, if I choose, let's say, an equity hybrid long short product, I can actually get debt-like returns with debt-like volatility, and yet generate a return which is better than any other fixed income asset class or any other, without taking the right kind of, without taking too much risk to my investments for the next 2 years. So I think that it will bring back the talk about asset allocation is what I feel about SIFs as a product.
Okay. Niranjan, you've also launched your own SIF as well. Give us an understanding of how is the early traction being seen among investors? What are the kind of queries that are coming in? And in this current scenario where the markets are absolutely volatile, lackluster to a large extent, still looming large uncertainty, is something that we are dealing with. In this kind of an environment, how are you looking at the interest that people are showing to SIFs?
Yeah. So the first product that we have launched from Edelweiss brand is the Altiva Hybrid Long Short Fund. It's basically in the hybrid space. We are trying to address two needs. One is, trying to generate very low risk returns to the investor, which are tax efficient. And because, as we discussed, the beauty of SIF is it can take derivatives. Now, derivatives can be used to enhance risk and return, and also reduce risk while keeping the return intact. So in this product, what we have tried to do is we have kept the return closer to hybrid funds like equity savings fund or balanced advantage fund, closer to that. While on the risk side, we have tried to reduce risk closer to fixed income products and arbitrage funds. So in this process, what you get is a product which can be low on risk, closer to fixed income arbitrage fund, but reasonably high on returns when compared to arbitrage and fixed income. So the positioning allows investors who want to invest for 2-3 years or as a part of their asset allocation in low risk product, yet generate a very good tax efficient returns over a longer period of time. That's the beauty of SIF, because if you use derivatives correctly, there are strategies like covered call, there are strategies like straddle, strangle, along with basic asset classes like fixed income. You create a beautiful product which is usually is not possible on the mutual fund platform, and which is much more tax efficient, because mutual fund platform is very tax efficient for investors and deliver a good experience. From investor point of view, when we went to the market, a lot of investors liked the concept, especially after 2023, when the taxation for fixed income has changed. People have been searching for an investment option which is tax efficient, yet give them a low risk, moderate return kind of risk return profile. So I think so there is a lot of demand from investors for this kind of product. Some of these structures did exist or do exist in Cat 3 AIF, but AIF per se, it's not a tax efficient structure for investors. You're getting a similar or closer to that kind of strategy in SIF, which is much more easier to understand, easier to invest, and with a lot of flexibility and tax efficiency.
Okay. Aditya, coming to you as well on the same part, and help us understand, since you deal with and gauge a lot of interest on digital aspect, first time investors, Gen Z investors as well. Give us a sense of how are they taking to this product, and do you see this is being seen as a product suited well for first time investors, Gen Z investors who have a long time of investment opportunity ahead of them, who have the risk taking capability which is much more than millennials or the older generations at this point? How are they taking to SIFs?
So I think Gen Z, of course, have a much higher risk-taking capacity. As we all know, India is the largest derivatives market in the world by volume. But I think what we have to remember is that whether we are Gen Z or a millennial, first we have to get our core right. And core might be again beating the same drum, but core has to be linked to your financial goals, and which are best made through long-term SIPs. So I think once your core is, and once you have additional corpus, which affluent investors usually have, a career, someone who's a Gen Z starting out his career his or her career will not have that kind of corpus, because the ticket size here is 10 lakh. So I think what we are seeing largely is interest is from affluent investors who already have their core set, and SIF then acts as sort of a asset allocation product where they are looking at 2-year kind of hold or 3-year kind of hold, and yet looking at sort of returns which potentially they can generate from any fixed income product, and with the right kind of tax efficiency, as Niranjan said. So I think that's what we are seeing right now. And I think our recommendation also to all our investors usually has been that if you are starting out, first get your core sorted, first get your core SIP started. Once that is in place, that and your additional corpus, then that is when you can add some flavor of different kind of risk return profile to your portfolio through SIFs.
Absolutely. Niranjan, coming back to your earlier point also, when we were explaining your own categories of the fund that you have launched, as far as, the kind of categories that are available, what exactly is on the platter for us to choose from? And of course, apart from this, on the taxation aspect, if you could give us more clarity vis-a-vis mutual funds, vis-a-vis direct equities, vis-a-vis fixed income, what is the kind of benefit we are getting here?
Sure. On the categories, like we have mutual fund categories defined, very well defined by SEBI. Similarly, in SIFs also, the categories are very well defined.
Okay.
There are three categories, equity, debt, and hybrid. And within these three categories, there are 7 investment strategies that are allowed. For instance, in equity, there are 3 strategies that can be launched. One, a diversified long short fund, one sector rotation or sectoral rotation long short fund, and the second one is X top 100. All these are closer to some of the mutual fund categories. The differentiator is all these categories can do long short, up to 25% naked short into derivatives can be allowed. On the debt side, there are 2 categories. One is a normal diversified debt long short, and the second one is sectoral debt long short. Again, here in versus a normal debt mutual fund, what is differentiator over here is they can do derivatives trade into fixed income. And lastly, in hybrid, there are 2 strategies. One is the asset allocator, which is closer to multi-asset. The only difference here is in this asset allocator, you can do a whole lot of things, right from REITs, InvITs, fixed income, gold, silver, equity, and derivative instruments of all these underlying assets. Which is the major differentiator. And the last category within hybrid is hybrid long short, where minimum 25% each is into debt and equity, and rest is flexible. So these are 7 strategies. Largely, we have seen most AMCs, including Altiva SIF from Edelweiss, has been on the hybrid long short side, given the current market conditions and the investors' need. Coming to taxation, the taxation for SIFs is very simple. It is exactly like a mutual fund. If it's an equity oriented SIF strategies, we saw 3 strategies under equity, where the equity exposure is more than 65%. The taxation is like equity mutual funds, where long-term capital gain tax is 12.5% after 12 months, and short-term capital gain tax will be 20%. On the debt side, there are 2 strategies. Again, the taxation will be like debt mutual fund. Any gains will be taxed as per your tax slab rate. And lastly, hybrid, depending on where the equity levels are. Like in our case, the equity level in our hybrid long short is less than 65%. Even fixed income will be less than 65%. So here the taxation is long-term capital gain tax after 24 months is 12.5, and before that it is as per tax slab. So it's simply put, all SIF strategies will have similar tax treatment like mutual funds, because in the Gazette notification that SEBI had put out for taxation purpose, they have clearly mentioned that SIF will be known as mutual fund units. So they have extended the definition of mutual funds to SIF units.
Okay.
So that's broadly on the taxation and categories, Sakshi.
Fantastic. Aditya, coming to you. Now, I want to understand, how Niranjan has been explaining as well. With SIFs now allowing strategies like long, short, even concentrated portfolios, how do these funds really help in diversification when it compares to traditional mutual funds, especially in times like these when we are not sure of what's going to be coming in next?
No, I think we've discussed this, and it's something that, so as you said as well, that in a sideways market, when I am investing for a 2-3 year time horizon, we always sort of investors want to look at, okay, what return can I make in a market like this, right? And if they're not sure of what is going to be the outlook like in next 2-3 years, then typically they sort of go back to a fixed deposit or park their money in the bank because they're not sure. So in that case, SIFs is a great product. I think the hybrid long short category, especially where they can actually create that kind of return without taking too much risk, and which is also tax efficient, because you're all, if your hold period is 2 years, you're only paying 12.5% taxation. So I think that category seems to be quite clear. I think what is less clear is how equity, the equity schemes that Niranjan also spoke about, how do those fare? I think, and can they generate alpha or other equity schemes, equity mutual funds? I think that is yet to be seen. But I think hybrid long short as a category seems to be quite clear where it's going, and it is in a market like this for next 2-3 years. It's a great alternative for people who have some additional corpus to park in markets.
Niranjan, there's this one thought that probably SIFs are seen as lesser volatile when they reflect in your portfolios than mutual funds. Is that a true way of understanding SIFs?
Partly yes, because the usage of derivatives is important. For what purpose are you using derivatives? So if you are using derivatives to reduce risk, like in mutual fund also today, balanced advantage funds is a category where derivatives is used to reduce volatility, cut down on equity level exposure. If that is the purpose, like hybrid long short fund or other funds in the hybrid category would tend to do this, and there the expectation that it will deliver low risk, moderate return is correct. Now, on the equity side, though it may not hold true, because in equity strategy, if someone is using derivatives to short the market and make that additional return, it may play both ways. So each and every SIF strategy is very important, is very distinct, and it will be very important to understand what the fund manager or what the fund strategy is. But if it is used in a way where you want to reduce risk, then what you said, Sakshi, is correct. Most SIFs will be able to deliver low volatile, equity linked returns.
Fantastic. Aditya, when it comes to, selecting your own SIF, just like how Niranjan also has brought in Edelweiss, Altiva, there are other fund houses also that are bringing up. What Niranjan mentioned is that most fund houses have started off with hybrid long short. There will be, of course, expansion in categories as and when we go forward from here. How would you advise an average investor to go ahead and do that selection for themselves? On what parameters is that selection going to matter?
It's the most difficult question, because we are yet to see any track record of fund managers in this new category. But I think there are some things, for example, talking about Niranjan's fund house, Edelweiss, I think they have a lot of experience in doing long short strategies, right? So I think we have to go at a fund house level and see, do they have experience in managing long short strategies? Because as Niranjan said, that what has been, the Cat 3 AIFs that we used to have in short category and currently do still have, the experience has been kind of mixed of end investors, right? So I think it's very clear that the fund house, what is the strategy, what is the design of the product? So if a fund house is giving that clarity, that okay, the design of this product is meant to reduce risk in your portfolio, I think that's the first indication. Because if the fund manager is very clear about what's the design of the product, I think that's the first indication. Second indication, of course, is that what's the experience of the fund manager in running long short strategies previously. So I think these two checks are most important. And then third, of course, if you have as an investor experience with that AMC and have had good experience with that AMC, then I think definitely you can go with that experience, because you know that okay, this experience, this AMC places a lot of has a lot of systems and processes to sort of select, do the right thing for investors. But otherwise, since there is limited data, it's very hard to right now say, okay, this fund manager has done the best. So I would say that, it's important to hear the fund manager, what I've been saying about the design of the product, and secondly, their experience in running long short as a strategy as an AMC or as a fund manager in their career. I think those are the two important criteria that at least I would look at right now until we establish track record.
Absolutely. Niranjan, if you could also help us understand, this minimum 10 lakh rupees ticket size, why did they keep this ticket size? And therefore, what, Aditya was also mentioning in earlier, that this actually goes on to show that people who have their basics sorted have already started off with their journey in mutual funds. Only the people who are moving on to the next step should be looking at this as an alternative strategy, because the ticket size is also large. How are you looking at this ticket size, and really who do you think is the target audience here?
Sure. So the reason for keeping this 10 lakh is I would say only one, because the usage of derivatives is important. As we discussed, how the fund manager is going to use derivatives, whether it will be used to reduce risk or enhance return by taking naked shots. That is important, and that is some level of complexity that investor needs to understand before investing into it. And 10 lakh probably acts as a barrier for a first time investor, because if even if he has money, putting 10 lakhs in just one strategy might feel a bit risky. So that is some small barrier that the regulator has put in a right way, which is important, because if your core will definitely be mutual funds, the basic mutual funds, and beyond that, when you are looking for better risk diversification in your portfolio, SIFs come into picture. So we see this as a very healthy start. Getting the right set of investors who already has large corpus and are looking to diversify into other risk return products is the right audience for this. The 10 lakh limit is also flexible, let me tell you. If you are investing in one SIF at the AMC level, it is 10 lakhs. If you are investing into two SIFs, say at Edelweiss, we have two Altiva SIF strategies. You can spread this 10 lakh into two strategies, 5 lakh in each. So that flexibility is there. You can invest across 2, 3 strategies if they are available at the AMC level, and spread this 10 lakh. After 10 lakh, the additional purchase, setting up SIPs, setting up SWPs, everything remains like any normal mutual fund. So 10 lakh is first. Later on, you can add on any amount that becomes the minimum for that strategy. So there is some bit of flexibility around 10 lakh as well.
Got that. So that's how differently you can use the 10 lakh amount as well, not just like concentrated into one strategy, but spread across in different strategies in case it is available at the AMC as well. Aditya, would you come in into this as well and help us understand when you're asking all your clients who are coming to you, what are you assessing in their current portfolio, and how are you recommending to them as to what kind of SIF categories to go forward with that 10 lakh rupees? Say somebody who's who has been in the investment space for last 5 years, has an exposure to a blue chip, has an exposure to a mid cap and a small cap, maybe even a flexi cap for that matter, or balance advantage or a hybrid fund. Then what is the next step if they are already, like what you pointed out, they already have their course sorted? So what next, and how would you advise that extra 10 lakh rupees to go into?
So I think I'll give you two examples, recent examples. So I think one example was a client who had put aside some money, SIPs, for last 5 years, and the goal was very clear that I want to accumulate 20 lakh rupees, and I want to use that to repay my sort of debt that I have. Now there is some there is now at least there is that he had a 5-7 year time frame. He's already accumulated the 20 lakh rupees, but he still the day payment is not due yet. So now what does he do? Because the payment is due 10 years, 2 years from now. So the risk is that either he can stay invested in equities, and obviously equities are unpredictable in 2 year time frame. So I think what he ended up doing, the client ended up doing, was that we used that 20 lakh rupees and actually used a hybrid long short strategy across two AMCs to park that fund with a very clear idea that 2 years is the time frame when the payment is due, and this money will then be used to repay whatever he or she wanted to repay with that 20 lakh rupees. And of course, this 20 lakh will grow because the market is where it is, and as Niranjan said, that we have chosen a scheme which is very clearly focused on reducing risk through derivatives. So I think that was not possible through mutual fund. Only other route was that we go through a conservative hybrid fund or a debt fund, which would have been tax inefficient. So SIFs actually played a very good role here, where money was to be parked for 2 years to meet a particular goal. And I think second example was again very similar, where an investor already has a decent sized portfolio. All the basics are covered, set for future. Retirement is secured, everything is good, and there was an FD which was maturing of the client, and client didn't want to put that money back in FD, even though client was very clear that this is my money that I don't want to invest for more than a 3 year time horizon. So in that case, again, SIFs came in handy, because again I'm repeating the same thing. Hybrid long short was a strategy where the fund manager was very clear that the derivatives are used to reduce the risk, and it made a perfect sense for that investor to park that money which was maturing through FDs in that SIF strategy where the hold period is between 2 to 3 years. So again, hold period was clear, core is set, and this product provided a sort of a safe haven where you have right kind of risk return profile. As advisors, as distributors, we often talk about the right kind of risk return profile. So this particular product had the right kind of risk return profile which matched with the client's time horizon of investing. So I think these are two examples that I can share from my recent experience of conversations with clients.
Okay. Niranjan, towards the end, help us understand for those who are now exploring SIFs as their investment opportunities that they want to now get into, what is the ideal time duration that they should be really looking forward to when they invest in it? How should they set their goals?
Right. So, because most of these SIF will be using derivatives, I think so. If the time horizon is minimum 2 to 3 years, it will be ideal uh, for hybrid strategies. If it is equity-oriented strategies, because the core will still remain equity, it will be stocks, and a small portion would be derivatives. Uh, the time horizon minimum should be around 5 years plus. So for hybrids, 2 to 3 years, and for pure equity, 5 years plus would be the ideal time horizon.
Okay. Aditya, last word to you. What is it that you would want all our viewers to take away from this conversation today? We've brought out every aspect of SIF that they must go forward and look at, of course, for themselves to really do the research and explore. But anything that they have to keep in mind as they begin to take this decision?
So I think I would say that financial product is not like an iPhone that you need to get one just because there's a new one out there. The financial product has to fit what your portfolio is looking like and will look like in 3-5 years from now. So I would say that's the biggest thing. Don't look at it as a new product which you must have in your portfolio just because of additional returns that it might generate. In fact, as Niranjan has made it amply clear, there are very clear. There is a strategy hybrid category which is only focused on the right kind of risk return. So if you are selecting that product to generate higher returns in your portfolio, that may not be the case. And as I said, it's something that don't treat it like an iPhone 17 or 18 or 19. Think of it, how it fits into your portfolio, and have the right conversation with your distributor or your IA and make that decision.
Fantastic. All right, on that note, thank you so much, Niranjan, and thank you so much, Aditya, for being with us on the show. I'm sure this conversation would help a lot of our viewers get the clarity about this newer product that's actually available now with a lot of fund houses, and of course, they'll be able to take an informed decision on SIFs when they want to explore their investment opportunities. Appreciate both your times on the show today. Thank you.
Actually,
all right, viewers, this is how we wrap up today's edition of What's Hot. But do stay tuned on to Business Today Television as market coverage continues on the other side. Right now, we've slipped about 78 odd points on the Nifty. 25,496 is where we are at. So we have given up that 25,500 mark. Let's see whether in the day to follow, we will see any pickup happen from this level, or will we see some more pressure from this level as well at this point in time? You are seeing most of the sectors that have slipped into the red now, barring just IT and media. Rest of the sectors have all slipped. It's the India Wix that's shot up by 4.5-5% and that's clearly leading to some problem on the D Street. And we are also seeing a large part of the Nifty stocks that are slipping into the red, barring just about 10-15 stocks that are still holding up into the green. Let's see how the day pans out in trade. Market coverage on the other side. In case you have questions about the stocks in your portfolio, Daily Calls is the show that you must watch at 12 noon today.